The government's report on the Consumer Price Index came in hot today, exceeding Wall Street's expectations and puts pressure on the Federal Reserve to make some serious moves to fight it. What's driving the latest inflation numbers? What does that mean for you, and what can you do about it? We're covering all that in today's video. Let's get into it. The Bureau of Labor Statistics CPI report showed consumer inflation running at a 7.5% year-over-year rate in January, the fastest since 1982. Wall Street was expecting the latest reading to come in at 7.2%, and now worries of an acceleration in the Federal Reserve's plans to rein in inflation by tightening the money supply sent stock markets lower. They have good reason to worry as well. For much of 2021, the Fed tried to downplay rising inflation and say it would just be transitory, but that story's not going to sell anymore. Not only is inflation persistently high, but it is accelerating. The 7.5% comes on top of readings of 7.1% in December, 6.8% in November, and you get the idea. In terms of what categories were behind the latest increases, food, shelter, and electricity were the primary drivers. These are not the categories you want to see heading higher as they hit consumers so hard. It's pretty difficult to get by without paying for food, shelter, and electricity, and higher prices in these categories could lead to lower overall economic growth. Because they are necessities and you can't easily substitute for them, consumers paying more for these categories are not able to spend as much in other categories if incomes don't rise as well. And while we have been seeing rising wages, they are barely keeping pace with rising prices, and for many people they are not. This could lead to a situation called stagflation, where economic growth is low or stagnant while inflation is high. But perhaps one of the most important repercussions of this high inflation report is that it will push the Fed to act sooner than anticipated, and they may need to raise interest rates higher than they would like to bring down inflation. The immediate danger here is that this will push mortgage rates so high that it could lead to a crash in the housing market if it happens too fast. Back in the 1980s, inflation got up to 14%, and right now we're halfway there. To bring that down, the Federal Reserve pushed up their federal funds rate to 22% in order to tame the inflation beast. This led to mortgage rates rising to 18%. Imagine if mortgage rates were 18% right now. At current home prices, virtually no one would be able to afford a home. Stay tuned to our channel as we follow how all this plays out and let you know how it could impact markets. In a recent video, we went into more detail on how Fed action can impact markets, so make sure to check that out as well if you want a deeper dive into that subject. At this point, you may be asking yourself, what can you do about it with prices rising for things like food, shelter, and electricity? Well, one way to think about inflation is not so much that prices are rising, but your purchasing power is falling. Your dollar just doesn't buy you as much as it used to. So protecting your purchasing power is one way to deal with high inflation. We started a series on this channel called Investing During High Inflation, where we're looking at different assets and commodities you can invest in to help protect your purchasing power. So far, we've looked at precious metals and cryptocurrency and how they could play a role in your portfolio to protect your purchasing power. I'll have a link to that playlist in the description down below. We'll be doing more videos on this topic, covering things like real estate and stocks and many other asset classes to consider during times of high inflation like we find ourselves in now. Make sure you're subscribed, hit that notification bell down below so you won't miss our next video in that series either. I hope this video has been helpful for you. Please give it a thumbs up to support the channel and help us grow. Thanks for stopping by. I'll see you in the next video.